Well, hello and good afternoon, good evening, good morning to everybody from around the world, and welcome to our Pillar 2 Are You Prepared session, where we're going to hear the views of Grant Thornton's experts from various countries around the dreaded BEPS Pillar 2, which we've been threatened with for a number of years, but is actually coming to town, coming to a cinema near you in the very not too distant future, if it's not already being shown at your local cinema. What we are trying to do today, or what we're going to do today, is take you through some basics of Pillar 2, just as a refresher, because obviously with the number of people that we have attending this, we can't be all things to all men. So we'll take a step back down memory lane and a bit of a refresher. And then what we're going to try to do is take things a bit further and take a more granular look at implementation issues and get a bit up close and personal with what we actually see happening already in Europe, where some of the action has started, and then looking at it a bit more closely in India, Asia, or certain countries in Southeast Asia, and Australia. Fantastic to see people from around the world. We've got people from as far afield as Peru and Auckland, although I suppose Auckland and Peru aren't that far apart if you go west or east, is it? But if you go the other way, we cover quite a lot of geography. So welcome everybody, even those, and in particular those that are up at 3 o'clock in the morning watching this. We will try not to disappoint you. So before we start, though, a couple of housekeeping things. Obviously, disclaimer, which suggests that we're not about to give you any advice. These are our own opinions. And of course, a lot of this, because it involves staring into a crystal ball, is something that we would have difficulty confirming to be true anyway. The webinar is going to be recorded. I hope everyone's okay with that. So the agenda today is as follows. We have a number of speakers, as I mentioned, from the Grant Thornton world, who are experts in the field of BEPS Pillar 2. I'll introduce them to you in a moment. As I mentioned, though, we're going to take a bit of a trip down memory lane back to basics, and that will be a basic session, which is about who is involved or who's caught by this, what is caught in particular, how do we calculate the various taxes that might be due, and we'll look later a bit more granularly at how you actually file and pay those taxes when the thing comes to town. Having got yourself caught in BEPS 2, which is slightly unfortunate, then we'll take a look at some of the safe harbor provisions and transitional provisions that may be able to get you out for the time being, or at least make life a little bit easier for you. The who, what, how is going to be handled by Richa, who I'll introduce to you in a second, and safe harbors by Paul. We're then going to take, as I say, this more granular look at what's happening around the world, the state of undress. As you can imagine, there's different things happening in different countries at different speeds. But of course, all of these countries are interlinked within the BEPS framework. So just because it hasn't happened to you just yet doesn't mean it's not relevant to you, because someone somewhere else may be influencing that position. So we'll be taking a look at that in the countries that we've chosen, which will be India, Australia, as I mentioned, Paul is going to take us around Southeast Asia a little bit and pick some of the interesting pieces out of that. And then Sasha from Ireland is going to tell us all about Europe. We're going to meld that really with a panel discussion. So hopefully we can get some good thoughts and ideas flowing and identify some of the issues that we're going to be facing as we go forward with this. So today's speakers, you've met me so far. And I'm not sure what order everyone is seeing people on the little panel at the top, but I'll take them the way that I see them. Paul Cornelius, who is with Grant Thornton in Thailand, previously practiced in Singapore, Myanmar, and Australia, so has quite a reach in the region and various cross-border situations. So he'll be telling us today about Southeast Asia update. We've got Murat Sihanga from Australia, who's going to tell us about the, I think, surprisingly an anomalous situation that we have in Australia. He can unveil that as he goes through it. We've got Richa Sawhney, who is a chartered accountant in India. And then finally, Sasha Kerins, who is a partner in GT Thailand, been in the thick of this, and she is, I suppose, at the thin end of the wedge as far as BEPS is concerned, because it has already effectively started in Europe. So we'll hear from all of these experts as we go, and I think the first up is going to be Richa, who's going to take us back through the basics.
Thank you, David, and hello, everyone. Let's talk about the basic concept of Pillar 2. Pillar 2, or Global Minimum Tax, as it is called, is part of the OECD two-pillar solution, which aims to redesign and reshape the international tax norms. And the essence is of this two-pillar solution is to ensure that multinational enterprises, they pay a fair share of taxes in whichever jurisdiction they operate. Now, as far as Pillar 2 is concerned, it seeks to end the race to the bottom by placing a floor on the corporate tax rates across the globe. And when we talk about the floor rate, the rate that is agreed is 15%. The idea here is to remove tax competition and shifting of profit to low tax jurisdiction. Again, as I mentioned, the rate which is agreed is 15%, but it's important to note that it is not the headline tax rate, it is the effective tax rate that is being discussed. Now, in nutshell, what Pillar 2 seeks to address is that in any jurisdiction, if the effective tax rate is less than 15%, then this tax must be topped up somewhere within the group. It is usually to be picked up by the parent company. And this would depend also on the countries in which the group is operating, which has adopted these Pillar 2 rules and can keep on changing on a year-on-year basis as more and more jurisdictions keep adopting these rules. Now, coming on to who is covered by these set of provisions. So these GLOBE rules, they apply to those multinational organizations or multinational groups which have an annual turnover of euro 750 million or more as per the consolidated financial statements. Now, what you have to check here is that this situation or this test has to be met at least in 2 out of the 4 fiscal years immediately preceding the tested fiscal year. And what is an M&E group? Even that is defined. It says an M&E group is a group of entities that are related through ownership or control in such a manner that consolidation of their financial statements is required at the UPE level. Also, in order to qualify as an M&E group for the purpose of these rules, you need to have at least one entity outside the jurisdiction of the ultimate parent company or the UPE jurisdiction. It could also be a permanent establishment. Now, there are also certain excluded entities, And when we say excluded entities, the implication is that they are otherwise not required to comply with the globe rules. It's just that for the purpose of determining the revenue threshold for the group, if they are part of a group, the revenue is considered. Now, typically, a government entity, an international organization, or a non-profit organization, a pension fund, these would be the excluded entities. The investment fund or a real estate investment vehicle is an excluded entity only if it is an ultimate parent company. Now, coming on to how these rules work. So this minimum rate of 15% is sought to be achieved through the interplay of two set of interlocking rules. Now, this is a combination of both treaty-based and domestic law-based rules. If we look at the slide here, we have income inclusion rule, the qualified domestic minimum top-up tax, and the under-tax profit rule. These are to be incorporated in the domestic legislation. And the subject to tax rule, that is a treaty-based rule. This is the STTR, as it is called. A rule priority has also been provided by OECD. This ensures that there is no risk of double taxation or overtaxation. Coming on to IRR. Now, this rule, it imposes a tax on the ultimate parent entity in respect of low taxed income of a constituent entity in the group. It follows a top-down approach. And what it means is that just in case the country in which the UPE is located does not adopt globe rules, then the application or the responsibility of executing or collection or payment of the IRR, it moves further down the chain to the next entity. Then there is the UTPR or the under-tax profit rule. It is required to act as a backstop to IRR. So in the event, for any reason, the IRR is not able to mop up that 15% tax, then this rule steps in. And how it achieves that 15% is through a series or by denying deductions or requiring any other adjustments that may be there. Qualified domestic minimum tax or QDMTT, this preserves the primary taxing rights of local jurisdiction. What is implies is that if by virtue of operation of these rules in any jurisdiction which is low tax, there is a liability to pay top-up tax which arises. If the jurisdiction has introduced QDMTT, then it can collect that tax within its jurisdiction itself, which if it was not there would have actually gone to the in form of IRR to the parent company jurisdiction or in form of UTPR in any other jurisdiction. Coming on to subject to tax or the STTR rules. As I said, this is a treaty-based rule. What it targets is certain cross-border intra-group payments where a benefit of a tax treaty has been taken. And in this treaty, if one jurisdiction has ceded rights of taxation to another country, and a minimum level of taxation is not happening in that other country, under this rule, the right flows back to the first jurisdiction to ensure that there is proper taxation. Here, the cutoff or the benchmark rate is 9%. Collectively, these rules ensure that they mop up around 15% of the global profits for any multinational which is operating in different jurisdiction. Now, let's look at the mechanism on how this needs to work. So what do you do first? Can I have the next slide, please? Is that you have to evaluate the applicability of these rules at each jurisdiction level. As I discussed earlier, the minimum ETR, effective tax rate, is 15%. How the evaluation is done is first you look at what are the adjusted cover taxes of all entities which are operating in a particular jurisdiction. And this is called the concept of jurisdictional blending. So all the taxes of the covered taxes of all the entities in a jurisdiction are taken. There are certain stipulated adjustments which are done. Then you need to compare that with the income or losses of all those entities put together based on the consolidated financials which are operating in that jurisdiction. The result is the jurisdictional ETR. Now, suppose in a situation where this jurisdictional ETR comes out to be 10%, so the top-up tax percent for this jurisdiction would be 15 minus 10, which is 5. The next step would be to give an adjustment or a carve out for whatever substance is located in that jurisdiction. And when we talk about substance, it means if there are any tangible assets which are located and if there are employees. So there is a prescribed adjustment which takes that value of the tangible assets and the payroll expenses in that particular jurisdiction. The net globe income or loss, which we computed earlier, is reduced by virtue of this this adjustment. There are certain percentages which are prescribed. The result is an excess profit on which, if this jurisdiction has adopted the QDMTT, the jurisdiction, the tax authorities of this country itself will pick up this tax. If not, then it moves on to the next stage where by virtue of IRR or UTPR, this tax liability has to be discharged in any other jurisdiction. Now let us see the interplay of these rules by virtue of few very simplistic examples. I would say very utopian examples here. First, let's look at the IRR. How does that work? Now, in this situation, we have the parent company in country A, and it has adopted GloBE rules and IRR. Country B and country C have not adopted the GloBE rules. Now, if we see country B, the effective tax rate here is 20%, which is way above the 15% benchmark. So therefore, there's no top-up tax which is required to be picked up from this jurisdiction. So you move on to country C. Now here, this is a low tax jurisdiction. And as you can see, the top-up tax percentage here is 15%. The top-up tax works out to be USD6. And since this country has not introduced GloBE, so therefore, the parent company at country A level needs to discharge this tax liability of USD6. So this is how the IRR works. Let's now move on to the next rule and see how that works. It's the UTPR. Now, UTPR, as I mentioned, it works as a backstop for IRR. And if IRR has not been able to do its work well, then that is when UTPR steps in. Now, let's look at this scenario. Here, country A has not adapted the GloBE rules, or it is a situation where it does not have a QDMTT or a domestic IRR, but it is a low tax jurisdiction. Country C has not adopted it. Country B has adopted GloBE rules, and it has also adopted UTPR in those set of rules. Now, if we work out the ETR for the country A, it is 6.25%, which means there is a deficit of 8.75%, and somebody has to pay these taxes. Now here, since country A has not adopted rules, or as I said, there are certain other situations, the responsibility to collect this tax falls back on the country B, which has adopted UTPR, and it will need to collect this tax by virtue of denial of deductions or certain other specified adjustments. Let's now move on to QDMTT. Now, in this situation, as I discussed earlier, QDMTT, the role is to preserve the taxation right of the country in which there is low taxation. So let's assume here that country A has adopted GloBE and IRR rules as such. Country C has not adopted these rules, and country B adopts these rules along with QDMTT. Now here, if you see this country B, the ETR is 6.25%. So there is a shortfall of 8.75%. Had this country not adopted QDMTT, what would have happened is this USD 7 would have to be paid in country A by virtue of IRR. But since this country has adopted the qualified domestic tax, therefore, it gives the right to country B to collect that in its jurisdiction itself. So thereby it preserves the right of this country to have it has a first right to collect this shortfall in the taxes. So that's about it from my side. Now I'll hand it over to Paul to take you through the safe harbors.
Thanks a lot. OECD in their, shall we say, have been kind enough to provide certain safe harbors that are aimed really at simplifying the calculations in certain years and leading to excluding certain entities out of the calculations. So let's turn to what is included. I'll come back to the transitional country by country reporting. It's probably the one most people know. It's the whole idea of that is to take out certain low risk jurisdictions, very much based on accounting data that's used for your CBCR reporting. I'll come back onto exactly what that is. The other three here are maybe not quite so well known. So we should already explain that we have a qualifying domestic minimum top-up tax, and that is in most jurisdictions. Most jurisdictions will want a QDMTT. They will not want their low-taxed income disappearing up to being taxed offshore. So we are finding, certainly in this region, nearly everybody will be adopting a QDMTT. What is a QDMTT safe harbor? That basically is saying if you have a QDMTT that is qualifying, and believe it or not, a QDMTT that is qualifying as a QDMTT safe harbor, which is slightly different, then you don't need to worry about top-up tax. Why is any of that relevant? Interestingly, let's take a look at somewhere like Singapore's law that sits out there. Singapore will allow a QDM, well, requires a local company that has a Singapore functional currency, even if that's not the functional currency of the group, would require you to prepare your domestic minimum tax, as it's called in Singapore, based under the Singapore functional currency rules. It will be required that the local company makes and lodges that return. That might not be an identical return to the calculations may not fully take out the top-up tax when you calculate the IIR further up the group, and therefore it is possible that you could still have residual taxation based on some differences, perhaps around currency, for example, that could give problems. This is saying, no, you don't need to worry about that, provided the tax in Singapore, the domestic minimum tax, is a qualifying domestic minimum top-up tax safe harbor, then don't worry, that'll be it. It'll be zero. There won't be anything else. That's all you need to pay. Like everything in this, I have to say, everything we look at in this law, we end up with conditions, we end up with problems, we end up with difficulties. So for the QDMTT safe harbor, not only do you have to qualify under the QDMTT rules, you have to qualify under certain accounting standard rules, you're required to have certain consistency standards, and you're also required to have a review. So how much you can really rely on this, I don't know, but it's not as straightforward as just saying, if you have a QDMTT, you are out. You still need to look at this in some detail. Simplified calculation safe harbor is really coming in. It's supposed to be providing us with easier rules, something that's easier to implement than the current global rules. When we start to look at the routine profit test, de minimis test, effective tax rate tests, what we have got at the moment are some rules around the non-material constituent entities. So these generally are entities that are not being consolidated for certain reasons around materiality in general, but there are rules around exclusion of those. We're still waiting on additional rules as to exactly what will be in the simplified calculation safe harbor. Transitional UTPR, we mentioned what the UTPR is, sort of the backstop. It mops everything up. And what it can also mop up is a parent company's, an ultimate parent company that isn't even in BEPS, like, for example, China in Asia. If it has low taxed income, then that is possibly mopped up as a jurisdiction, mopped up under the UTPR into one of the subsidiaries below. There is transitional relief available in the ultimate parent entity jurisdiction, provided that entity has a corporate tax rate of at least 20%. Probably very unlikely, therefore, to have low tax, but anyway. And that is only going to be applicable really for the 2025 year. So actually covers any period ending up to with a year end before December the 31st, 2026. It's, for example, works for the US, which is obviously the main entity, a main country that is staying outside at the moment of BEPS Pillar 2. So with a US holding company, ultimate parent entity, then this is to provide some relief from the UTPR that could possibly apply. They're all interesting, slightly esoteric, but the real one that probably we should focus on is the transitional country-by-country reporting safe harbor. This is something everybody needs to do. Everybody needs to look at their group and determine whether we've got an easy out. Do we need to worry for the next 2 years, for 25 and 26, about the jurisdiction? It's always a jurisdiction. We've always got to look at the jurisdiction. It's not each entity in the jurisdiction. We need to look at the jurisdiction. If we could have a next slide. Going now. This has 3 elements to it. So we can look at the transitional safe harbor. If we qualify under any of these, then the entity at the moment does not need, during the transitional period, to worry about being subject to a top-up tax. And these are all based around not global income, not covered taxes. It's based around the numbers that are being used for your country-by-country reporting. So it's around CBCR data, hopefully much easier to obtain than the calculations of global income. The first exclusion is going to be anyone who has a revenue of less than 10 million euros and profits of less than 1 million euros. They're taken out under a de minimis. Second is going to be an effective tax rate. So the effective tax rate calculated under CBCR data rather than under the Pillar 2 data, rather than global income covered taxes. If we're at 15% through 24, 16 through 25, 17 through 26, then we can again rely on this safe harbor to take us out during this transitional period. And finally, something again we mentioned, this is it's a safe harbor calculation, which is really based around the substance-based income exclusion. So what it's saying again is you can use your data, your CBCR data, and if your profit under that data is going to be less than the summation of your payroll carve-out and your tangible assets carve-out, again based on that CBCR data, then you don't need to worry about the reporting. It'd be a nil reporting jurisdiction. So the payroll carve out again would come down to 5%, started at 10% of your payroll costs, and it transitions down over 10 years, 8% down to 5% for the tangible assets carve out. So again, you need to do those carve out checks, but you're doing them against data you should already have, hopefully. Just a word of warning, you do need in each jurisdiction, and there are again, surprise, surprise, rules around exactly what will and will not qualify as for country-by-country reporting. So the country-by-country reporting has to be basically has to hit certain qualifications in order for it to be able to be utilized. Your data has to qualify, enabled to be utilized for these safe harbor tests. If you have a problem with your data in each jurisdiction, then that is an issue that you will need to either rectify or you will not be able to use this test. So looking at how we might assess this, how we might look at it, This is just a map of sort of traffic lights, looking at every jurisdiction, taking into account, based on your CBCR data, where you are in each country. Have you got a problem? Do you have a problem? If you have a problem, what will these tests take you out? So we start to look at whether or not the transitional rules can apply jurisdiction by jurisdiction. Every group either should have done this already, and I'm sure anyone that's coming out of the Europe, Japan, and any of the countries that are already in this Korea, in this region, will have already done this. But it's very, very important that you do this test so you understand what is going to fall out under the current transitional safe harbors, or indeed permanent safe harbors, and that you don't need to worry about, that you don't need to do the calculation of whether you're low taxed or not. So please take a look at this. It's very important, and it's almost very much the first step that you need to be doing in terms of your planning. I'll hand back to David.
Thank you, Paul. It strikes me that some of these safe harbors have more complex rules around them than actually just stumping up and paying the tax.
Yeah, they keep on adding extra administrative requirements, etc. It's
yeah.
Nothing
new from the OECD, but we won't go into my thoughts about it. So what we're going to do now is look at what I call the state of undress around the world, because as I mentioned earlier, we've got legislation coming in, or that already has come in with effect from 1 January 2024. So we're halfway into that process in some countries around the world. In fact, quite a number of countries around the world. Other countries are not bringing things in until 1 January 2025, and then within that, there's other things, other timings that are knocking things out of kilter as well. So, Nat, can we have a look at the slide? It's sort of lighting me up. There we go. So as you can see from here, quite a number of countries already have got rules that have come into effect from 1 January 2024. There are notable exceptions on this slide, which would be India, Thailand, and Singapore and Australia. And that's not that we did this on purpose, but it also happens to be the countries that we're going to look at specifically in a minute outside of this. But what I'd like to do first of all is ask Sasha, because as I said, she's at the thin end of this wedge where stuff has already started. And I suppose our interest there is in getting down just to the nitty gritty, the facts, the processes, and of implementation. So I was just wondering if you could give us a talk through things like reporting requirements, what has to go into your statutory accounts around this, what provisions you might have to put in the context of the taxes that could be coming down the tubes, tax returns and notifications to various revenue authorities. I know a tall order, but I think there seems to be some rationale behind it, but obviously some exceptions as well. So maybe you could just talk us through that as a starter.
Yeah, thanks, David. Maybe just to clarify from a European perspective, I suppose Europe has led this from the start, with the directive being published in December 2022. The requirement for all EU member states to have the legislation from that directive adopted into their domestic legislation, making the IIR effective from 1 January 2024 and the UTPR from 1 January 2025, with the optionality as to whether they will adopt QDMTT or not. So what we see, obviously from a legislative perspective, most EU member states now have that legislation implemented. It was done either the latter end of 2023 or at the start of 24. There's three key states that are still in draft legislation state, so that being Portugal, Spain, and Poland. And I suppose we're in a situation where we've legislation that's effective from 1 January 24, but actually not effective in certain jurisdictions. So that impacts on some of the discussions we're having around interpretation, timing, and how this is all going to roll out. Dealing with your specific points, there has been guidance. So, a lot of clients and businesses on the call with us today will be saying, where am I in the process? We're seeing some large multinationals very far ahead and have done a lot of planning, subject to the legislation they have available to them. Other people are starting to look at the process. But I suppose we break it down from a timing perspective, to the extent Pillar 2 legislation is in place in the territory, the accounting standards boards have issued some guidance and says within your 2023 accounts, you do need to put some disclosures in relation to Pillar 2 in those accounts. The guidance, when it came out first, gave us an indication we were going to see quite a lot of data. There's a requirement for there to be a qualitative element of it and a quantitative element of it. But some of the disclosures we're actually seeing being disclosed in financial statements are quite light. And just to maybe give you some practical examples, on the Irish side, what we've seen is, yes, we're in scope of Pillar 2. Yes, our domestic rate is effectively 12.5% if it's Irish. Our effective rate for 2023 was X. And as a result of Pillar 2, our effective rate is now going to be 15%. We're not seeing lists of territories that are impacted. We're not seeing that element of qualitative or quantitative data being included, but really a guide. We've seen some instances where companies have said, well, we're only in scope from 2023. So as a result of the 2-year rule that Risha talked about, we won't really be in scope for a Pillar 2 perspective until 2025. So again, disclosures, but light touch and varied. So it's interesting to keep an eye on that when you're talking to your auditors and come up with a process. And obviously make sure it's reflective of what also may be considered, because your UPE may be in the US or in China or in one of those territories where ultimately Pillar 2 is not effective. So you need to have a consistent policy across your jurisdictions. Secondly, then looking at provisioning. So again, what we're probably seeing is a light touch approach. Multinationals that are doing quarterly provisions. Again, I'll take Ireland as an example because we have a headline rate of 12.5%, but obviously have adopted QDMTT. So there will be a top-up tax to an effective 15%. And from the point of view of quarterly provisions, that obviously needs to be accounted for. In some cases, people are being quite light touch with it and are just doing a 2.5% top up on a quarterly basis. Others are being a bit more detailed. What I would say is when you come to your Q4 provisioning, obviously the basis on which the Pillar 2 calculation works that Risha went through earlier is very different from the way it works from a domestic perspective. So you really need to get into some of that data and make sure you're working through it in a Pillar 2 basis to make sure that provisioning in Q4 is accurate. And that would be some of the conversations we're having and supporting clients in that space as they move forward. When we look at tax returns, again, within the EU, effective from 1 January 2025, for the first year of filing, you have a transitional filing date of 18 months after the year end. So we're looking at June 2026 for any filings in that regard. Different jurisdictions are taking different positions in relation to payment. So the Irish tax authorities have said that the top-up tax will be separate to your normal annual corporation tax, and it will be paid when you file your return in June 2026. We have seen last month the Belgian tax authorities have already launched a platform where you can make advance payments under Pillar 2, and they have certain penalty requirements, etc., around that. So the Belgians have gone quite far ahead in relation to where they're at in relation to implementing their position. Secondly, notifications. Again, you talk about the EU, we have one directive which has to be unanimously included in all domestic legislation. There should be an element of consistency then in that regard, you would think across the 27 member states. But for example, we have Ireland saying that your notification requirement to say, yes, we're in scope for Pillar 2 that you have to file with the Irish tax authorities is filed 12 months after the year end. Belgium have come out and they actually had a notification filing date of July For any businesses that aren't aware of that, that are on the call, they have allowed an extension for that filing date to the 16th of September, which is in a few days' time. So if you have an entity that's in scope in Belgium, you do have to make a notification filing with the Belgian tax authorities by the 16th of this month. The requirements around what Belgium are insisting is included in that notification is quite all-encompassing, and a lot of detail being requested, whereas in other jurisdictions across the EU, we're seeing that notification being quite light touch. So again, even across the EU, David, we're seeing a variety of how this has been implemented being varied across member states.
Well,
so I think that's most of the points I've covered that you give me.
That was fantastic. The question that comes to mind there is the timing of the payments, because looking at Singapore, it's got a prior year basis of taxation, which means you earn your profits first and then you assess them in the following year. It sounds pretty much as if this is the way it's going to happen under BEPS 2 in general, whereas some countries pay their tax on a real-time quarterly basis. So the whole thing will be completely out of kilter at the end of the day.
Yeah, I think that's the challenge. We have model rules, we have domestic legislation, we've OECD guidelines, which are constantly changing. We had another issue, another set of guidance and updates issued in June. And then you have local governments trying to implement that and interpret it within their domestic legislation.
Yeah. Interesting stuff. So you'll be doing nothing but paying tax basically on a continuous basis, by the sounds of things. But anyway, thank you for that. I'll have some other questions for you later on, so don't go away. But I think that means we can probably use this as a segue into the roundup for the other jurisdictions. And I was planning to start with Paul. I think, Paul, you're going to cover Singapore, Thailand, and possibly Vietnam, which was mentioned on the earlier slide, because that looks like it was an early adopter. But I think you got something to say around that.
Yep, sure. I'll update on where we are around Asia, Southeast Asia, which is, I guess, my area. You're right. Vietnam is the early adopter in Southeast Asia. Asia overall, Japan, Korea are already in, so there we go. But in Southeast Asia, Vietnam will be starting in 2024, even though their legislation is drafted. It's still to be, shall we say, passed, which is expected in October. Interestingly, they only have a 12-month. It's not just a reporting period, but at the moment they've got 12 months after the year end to calculate, prepare, and submit their returns, which seems to be way tighter than we're expecting under the guidelines, and the ability to extend even on that reporting period in the first year. There's none of that in Vietnam at the moment. Consistent with nearly everywhere else in Southeast Asia, the UTPR is not featuring as of yet in Vietnam, but Vietnam are the early adopters, so they are in. Rest of Southeast Asia, we've got Singapore, Thailand, and Malaysia, who will go in on the start of 2025. Singapore has not just draft law, but actually has issued guidelines by the IRAS around how they expect things to work. So actually good news from Singapore, and there's at least a little bit of clarification on what they're expecting. Malaysia, we've got little clarification, but we do have law. Thailand issued very high-level law, draft law, for public commentary, but to be honest, there was a lot of the detail that was missing, and we're still waiting on it. So we haven't seen that come through as of yet. We're expecting it sometime this year, we would hope, given that it'll be in place for next year. But still nothing back on that one. Singapore's laws are quite interesting to see. One of the things I did note in there, it's relevant. We talked about the idea of the top company being potentially a low tax jurisdiction. Singapore is an area where you can get not just a top company, but maybe something sitting underneath China, the US, or a haven, where we could be looking at Singapore even as an intermediate holding company. But Singapore's new laws around the domestic qualifying domestic tax, the minimum domestic tax, as it's being called, will kick in regardless of if top-up taxes coming under an IIR, regardless of whether you've got a UTPR issue. They will kick in. So this the qualifying domestic minimum tax in Singapore is going to apply from the 1st of January 2025, and you will be paying it regardless of whether you would otherwise have that income being sucked up to somewhere else or not. So I found that quite an interesting development. What else are we seeing in the region? Philippines, really nothing at the moment coming through. Indonesia made a lot of noise, but we're still not actually sure whether it's going to go in or out. So originally they were talking about 24, but now we're still pretty much in limbo in Indonesia as to whether they're going to adopt or not. So we've got a very, very varied and different position when we look across Southeast Asia, different periods. And I come back. So, I mean, Singapore has deferred indefinitely the UTPR. The only place where UTPR is actually sitting in the potentially in the draft law is, God forbid, Thailand. Hopefully the Thai authorities see some sense and defer the UTPR for at least a year, or again do an indefinite deferral, as we're seeing in most of the rest of Southeast Asia. But it's the first draft of the law that came out did potentially bring in the UTPR in 25 for Thailand. So very varied, very different stages of getting the law in, and very different in terms of actually providing real guidance to taxpayers.
Okay, thank you for that. Now then, Richard, I think we had a question in the Q&A which was pretty close to the one I'm about to ask you anyway, which is, what's the situation in India? When is the government likely to do anything about it, or are they just going to continue talking and never come up with it? And I think the question, Nat, can you show me the question that we had, which touches on this? Yeah, how is India going to digest this tax effect? So, if you're looking for a good meal, how are you going to digest it? So maybe your thoughts around that.
So David, it was expected that the government will provide a roadmap for implementation of Pillar 2 in this year's budget, and that was in July 2024, and roll out a draft legislation for public consultation, but there was no announcement to that effect. However, we've seen revenue officials indicating that the law is being formalized or finalized, and it's in the final stages, and it is perhaps just a couple of months away when they'll be releasing it for stakeholder consultation. Overall, if you see, India has always reiterated its commitments toward the Pillar 2 solution. And in fact, if you see in this connection only, equalization levy that was being levied in India, a 2% levy on e-commerce operators, that has been withdrawn in this year's budget, and it has been removed from August 1, 2024. And while doing so, the finance minister has indicated that this has been done keeping in mind the current negotiations for Pillar 1 or Pillar 2, and they're saying that they're constructively engaging on that. So we hope to see our draft legislation fairly soon.
Okay. You hope to see it, as opposed to hope to never see it, which I think a lot of people would like. Okay, which brings us to Australia, which is an interesting one. And I mean, I may come back to you on India because I think it may share the same issue. But Murat, what's going on in Australia? When we last spoke, you seemed to think that people were still going around in a bit of a daze about.
So Pillar 2 legislation has been introduced to Parliament in July, and it's working through the legislative process. So from the draft legislation provided, it will include the income inclusion rule, the undertaxed profits rule, and the qualifying domestic top-up tax rule. And the start dates for those will be in line with basically the globe rules, essentially. So 1 January 2024 and then 1 January 2025 for the UTPR in regards to those rules. One area that there has been very little discussion on at this stage is around whether Australia would entertain or consider amending their treaties to accommodate the subject of tax rule. So there hasn't been any further development on those areas, but we have essentially committed to the other three rules consistent with the start dates, as well as the 18-month deferral for the first lodgement. So 30 June 2026 is also the first lodgement period that we expect to see. The sentiment in Australia is it's a matter of when these laws will be enacted rather than if. So it's just churning its way through the wheels of the legislative process in Australia.
Sure, but what you're saying is that you've got law that is in force but hasn't been enacted.
That's correct.
Right. Yeah. Now I've seen that before in Australia. When Paul and I were boys in Melbourne, they introduced CFC legislation, which was law for 2 years before they had the law. So this is nothing new for Australia.
Absolutely. They're banking on the fact that a first lodgement is not due until 30 June 2026. And the expectation is that there's a fair bit of backfill required. So the expectation is they'll get the legislation enacted. They'll have the appropriate guidelines as well as the administrative items such as the actual returns that are required to be lodged.
Right. Okay. And the other question which I had for you and probably for Richa as well, which is that because of the comparative high rates of tax, and Richa, I can't remember what it is specifically in India, but it's not less than 15%. Is this not a lot of hoo-ha and trouble for nothing at the end of the day?
Yeah, so from an Australian point of view, where the headline tax rate is 30%, especially for cities within scope, it's much higher than the 15%. However, when you take a deeper look at the rules, it is an effective tax rate calculation based on covered taxes. So there are circumstances where anomalies could arise such that top-up tax could apply. Example, one of the areas that can create an anomaly is around deferred taxes, which is a part of the covered tax. So under the rules, you have to convert your deferred taxes under the minimum tax rate of 15%, whereas our deferred taxes are recognised at 30%. So that conversion from 30 to 15% would create some anomalies, as well as other areas where we've got our R&D concessions that could bring the tax rate down. Our interaction with our tax consolidation rules on M&A transactions, which can result in uplifting of tax cost bases, as well as obviously the tax losses, which could have an impact. So if you have some wild swings around your timing differences and you've had some unusual outcomes associated with tax consolidation,
right,
you could fall within these rules. So you do have to have a closer look at it. But speaking to your earlier point around it, it is a lot of work to get to a point where you may not pay top-up tax. That is actually a fact. You still absolutely have to go through the process, even if there is nil tax. And that's, Australia has committed that irrespective of whether you have top-up tax to pay, you still do need to lodge your IRR return, your UTPR return, your global information return, or your foreign lodgement notification. So essentially, you're still required to do all the necessary calculations and then file the necessary lodgements with the authority. And probably where the biggest stinger is with Australia compared to many other jurisdictions is that all entities that would be subject to Pillar 2 would be considered significant global entities for Australian tax purposes. And why that's critical is because we have a very punitive late lodgement penalty regime for significant global entities. So if you lodge a filing a day late, for example, the minimum late lodgement penalty is $165,000 at the moment.
Wow.
Can scale up all the way to $865,000 Australian for a late lodgement. So, and at the time of this, it looks like these filings under Pillar 2 would fall within those administrative penalties. So getting these lodged on time is going to be absolutely critical from an Australian point of view. Because there will be significant late lodgement penalties.
Right. Even though there may be no tax at stake.
That's correct.
At the end of the day, that seems very bizarre. But Richa, what about that in the context of India? Because as I say, your rates aren't particularly low when I last looked, and certainly you wouldn't have the consistency that you get in Ireland, where you've got the 12.5%. More or less across the board. So what's that going to do for India?
So in general, our rates are higher than 15%. So we would have quite a few of these rates depending upon whether it's a manufacturing company, whether you avail certain exemptions or deductions. So it could be 15%, 22, 25 or 30%. So this would be the overall scenario. So, but again, as indicated, that these are the headline tax rates. So particularly for those which are which fall under the 15%, there may be an assessment required to see whether at all the effective tax rate comes out to be lower. Our AMT our minimum alternate tax is also 15%. So those on the borderline situations, they may possibly need to evaluate again. But what we anticipate in case of manufacturing companies which enjoy 15%, the substance-based deduction should take care of quite a few things. But there is one area where particular attention is required, and that is in the case of the IFSC that we have, the GIFT City.
GIFT City, yes, I was going to ask about that, yeah.
So that is a place where there is a tax holiday for 10 years, which is available out of a block of 15 years. So an assessment is required there to see the impact. Of course, there will, again, you have the substance-based adjustment, which you could bank upon. The other thing is that if you have units in the other parts of India, so by virtue of the jurisdictional blending, if at all this gets sorted out, so that is something that possibly needs to be examined.
Okay, interesting. Which sort of brings me, Kunpal, onto the question of incentives, which is a big question mark for people in Singapore, because Singapore obviously has a lot of tax incentives to encourage foreign investment. And the question is, how is this going to be impacted by it? Or is the substance rules going to take care of it?
I don't think the substance rules will necessarily take care of it. No, we talk about much ado about nothing. It's very interesting. I mean, obviously Southeast Asia, we have a lot of tax incentives. It's been a common form of attracting investment, and therefore we're all across the board probably likely to introduce a qualifying domestic top-up tax. So very little is going to filter back up to the holding companies. It's mainly just going to be an increase in the taxes in local jurisdiction. How much top-up tax will we face? Well, I mean, we know Singapore's effective tax rate, average effective tax rate, around 7 to 8%. So we're certainly way below 15. Thailand, for a lot of investment as well, way below. Both of those countries, very little in terms of the outbound. I don't know what the number is exactly in Singapore, maybe 20 or 30 companies that are actually going to qualify as ultimate parent entities, maybe 60 to 80, maybe even up to 100 in Thailand. The real issue, though, is on the foreign subsidiaries, the foreign entities that are operating with very low tax rates for example, in Singapore and Thailand, where we have significant tax incentives. And I don't believe they're going to be brought back by the substance-based income inclusion. That's obviously based on a return on capital and a return on payroll. Singapore, for example, has huge trading entities where a 10% return on payroll is not even going to be close to the types of returns that they're getting under something like a 5%, 10% type tax regime that they could be using. What we are seeing already are some changes. Singapore has obviously changed to bring in an investment tax credit, which is a qualifying refundable tax credit. That has a different mechanism when we come to calculating the overall effective tax rate under Pillar 2. And if we use qualifying refundable tax credits, we could get ourselves either out of or significantly reduce the top-up tax that we'd be bearing. In Singapore at the moment, it's only going to apply really on capital spend, new capital spend. That's what this the new credit will be. We haven't seen that, for example, in Thailand. In Thailand, what we've actually seen is you can choose to increase your tax rate and increase the period over which the tax incentive would apply. So that's being offered. We are certainly, as Grant Thornton, putting submissions into the Thai government that you really need to consider qualifying refundable tax credits. These countries have chosen to use tax credits as only one, obviously, of the methods to try and attract investment. Taking that away just means they're going to be looking for other avenues. But I do think we should be looking at indeed lobbying, not just in Thailand and Singapore's possibly already the boat's passed because you already have in Singapore something in place, but the whole issue of qualifying refundable tax credits is not being addressed as widely as it should be in Asia, where we are seeing very wide use of tax incentives.
Sure. Yeah, I mean, Sasha, I was going to ask you about refundable tax credits. Is that something that is cropping up in Europe?
Yes, it is. And we've actually seen domestic legislation change. So Ireland, we changed our domestic legislation around how our R&D tax credit works to make sure that it obviously would be considered a qualifying refundable tax credit. And it's interestingly, there's some commentary now around, developing countries and their view around Pillar 2, and that it really isn't fit for purpose in helping them attract businesses to their countries, given the incentives, as Paul indicated, that need to be provided to attract investment. And it's been looked at, I understand, at an OECD level. So the question is, will we end up in a situation where, what's included in qualifying refundable tax credit for Pillar 2 purposes ends up really diluting what we're trying to achieve with this legislation overall, if that list is expanded and some of these are considered to be qualifying. So it's an interesting topic, definitely.
A lot of stuff seems to be going around in circles, if you ask me. But Murat and Richa in India and Australia, have these things reared their ugly heads at all? Or their helpful heads, I suppose?
From an Australian point of view, not much discussion has gone through on it. Our R&D concession is not as generous as other jurisdictions, and we don't really offer too many other sort of federal tax-based concessions that could create an issue in that regard. So I would say it's low on the priority list from an Australian perspective.
Okay, and Richard, not developed enough to get that far?
Yes, I think we are still in a wait and watch mode here.
Okay, yeah, because it's interesting because Singapore has come out with specific ideas and almost pushing you towards using these things or taking advantage of them. I mean, I'm conscious of time here, but I'm having so much fun asking you all these lovely questions. But one thing that came up, Sasha, when we were talking the other day, which intrigued me, and Richa sort of touched upon it when she was talking about the UTPR, which is, you said there was a Belgian case where they had gone to court to say that that the UTPR, i.e. presumably something coming back down from another jurisdiction, wasn't constitutional because the Belgian government didn't have the right to tax it because it was some other countries. business, I suppose.
Mm-hmm.
So what was that about?
So this is a US multinational in July filed a submission with the Belgian courts, and it was seeking an annulment in Belgium of the Pillar 2 UTPR law, which was obviously transposed into Belgian law on foot of the EU directive. Okay, so EU law intros. And ultimately what it's saying is in the submission that the UTPR violates Belgian constitutional law because it violates the principle of territoriality under their constitution, the way the Belgian constitution is drafted. Okay. Because obviously under the UTPR rules, if you have a US corporate which has an implemented Pillar 2, Belgian underneath, outside of the transitional safe harbour timeline that Paul talked about earlier, you'd be in a situation in Belgium where Belgium would have to capture any tax, top-up tax from the US entity within Belgium. And under the Belgian constitution, there's a view that it's unconstitutional. So this is really, really interesting because obviously they're using the way the Belgian constitution is drafted to take this challenge. But obviously they're also challenging the wider EU directive, which all of us within the EU have implemented in our domestic legislation. So it's one to watch. With all things in the courts, it's going to take time. I understand there's a 12-month time frame in which the Belgian courts can take to look at this point. And then if they go to the ECJ for some sort of ruling on particular legal points, it may take longer. But definitely an interesting development in the Pillar 2 conversation.
And I mean, just thinking, Paul, about Singapore's territorial basis of taxation, because if you take a step back, a lot of this is CFC rules for sort of everything offshore. Is it not? I mean, CFC have the exceptions.
Absolutely. If we took a Singapore ultimate parent entity or an intermediate holding company that was sucking up IIR, yeah, that's sucking up offshore taxes. We've got no CFC rules. We basically tax on a remittance basis. But this is a new tax, and therefore it's falling outside of our normal tax principles, we believe. But you know, is it or isn't it? I mean, that's something that we really need to look at very, very carefully. But it has been put up as if it's a new tax.
Yeah. Well, interesting. I think, you know, the more you look at these things, the more seems to drop out of it at the end of the day, which sort of leads me to some closing questions, because we're running out of a bit of time here, which maybe pulls these together. And one of them is this a train crash waiting to happen? And if it is, will it be a high-speed train crash into a wall or slowly off a cliff? Murat.
Yeah, look,
maybe think just a lovely thing.
That's a very visual picture you've painted there. Look, I think the biggest challenge, and it's been flagged as part of consultation, is the data points and the heavy compliance burden that this is going to require to undertake. And you know, I think in local consultation, Australia's looking at saying not all the data points are in their ERPs. They're going to have to manually extract data points from other areas, and then they obviously have to put that into a format consistent with the calculations. And even though the first lodgement is 2 years away, I think the sheer scale of these multinational organisations and the number of countries they operate in, the complex structures that they have, I think it still seems like a monumental task or challenge to get those ducks in a row to sort of complete this on a timely basis, especially from an Australian point of view, where you have also these administrative penalties looming if you don't actually get it right or for a long time as well. So
yeah, sure. So what you're saying is that in due course, once we get used to it, it'll probably sort itself.
That's probably, I think so. I think if we compare it to the CBCRE local file, I think there was a large challenge in getting all the necessary data points to do that. I think this exercise is much larger than that. But, if I draw back to that scenario, I think a lot of businesses were, putting up a challenge to get the necessary data points and filing, and there was some growing pains and a period of, of getting all of that set up. But following that, I think businesses are taking control of it, albeit with public CBCRE rules coming in, that's probably throwing another spanner in that space as well.
Richa, what about, because your train hasn't come out of the station yet, but I always maintain that trains have got to come out of the station before they crash.
So I think to my mind, David, if you look at what OECD data they have released in the recent past regarding the corporate tax rates, they seem to indicate that, these rules are actually working. There was a fall in the corporate tax rates, which has stabilized now, and there are certain modest increases also, which we are seeing. But I think the question that comes to mind is, the extent of complexity that has been created. As Sasha mentioned, if you are somebody who's looking at international tax today, you deal with domestic interpretation, treaty interpretation, the MLI, the ever increasing OECD literature on this, the new MLIs that are going to come. So which is actually too much to assimilate. And I've seen certain MNCs who are grappling with how to keep the concerned people updated on all these changes. So whether, inadvertently you end up doing certain non-compliances, which could cost you so much. So I think that is a concern. And whether what is sought to be achieved, now you're seeing a QDMTT cropping up in almost every jurisdiction that is going to implement, whether it could have been done in a slightly simplistic manner. If I were to take the situation in India, we're currently evaluating whether, our own law, the domestic law of income tax, needs a comprehensive review to make it more simpler, lucid, and shorter. So while that exercise is being done, all these additional compliances that flow in on account of the implementation of Pillar 2. So one wonders whether it will wipe away all the benefits that go into that exercise of streamlining our own act.
Yeah, indeed. Sasha, what's your gut feel?
I think this is really interesting. 40 of the 140 countries have only moved forward at this stage, so not even a third. Okay, right. Obviously from the EU, we've all adopted it, and it's in our legislation. But even globally, that footprint is really interesting. The OECD has driven tax policy for the last 80 years, but we've seen a move in the last 12 months that the UN are now moving forward with creating a terms of reference for a UN framework on international tax competition. And the view being, again, the developing countries feel they don't have a voice at the OECD table, and it's the larger countries that's driving tax policy globally. So I think it's really interesting. We have Pillar 2 legislation, we have model rules, but we have a rhetoric around how tax policy is going to be driven in the future. The EU were quite vocal, have put in a lot of directives since 2008, but a lot of directives that EU have currently on the table since 2022, they haven't been able to get over the line. So I think globally we're in a very interesting position. I do think that they've moved too quickly with this. I agree with Risha. I think a lot of the initiatives that they put in place originally with BEPS, they're actually seeing a result. So tax havens are being extracted from structures. Double dips are kind of gone, because a lot of those interest limitation rules and stuff that have already been implemented, I think maybe they've moved too quickly with this without letting that legislation itself bed in globally.
Sure. I think that was always a criticism with what the OECD have been trying to do anyway, is it not, since time immemorial? But interesting that Pillar 1 has all but been binned. So, and I suppose the other thing was I hadn't realized that many countries hadn't actually moved forward, but it is interesting that they may be voting with their feet. And there's a difference between signing up to something that is a concept and adhering to it when you see the detail. And that could be the sort of situation we're in, which is, hey, I didn't sign up for this. we had a different vision of what this was actually going to look like at the end. So I do think it's an interesting question. And Paul, last word from you before we sign off.
We've created in Pillar 2 a compliance nightmare. We really have. I'm more worried about penalties and problems, and we really have created a problem for companies. And for what? In this part of the world, yeah, we do use a lot of incentives, but we're going to have the domestic top-up tax in most countries, if not all, where we've got problems. And those countries are just going to find other way of trying to make themselves attractive to investment, whether we're using refundable tax credits, whether we get a change to, as we were saying, to those refundable tax credits to be a broader category. But there are other ways of incentivizing. I don't know that I'm not seeing any great benefit in this part of the world from Pillar 2. And I'm seeing potentially an enormous cost of compliance. And most firms are nowhere near ready.
Yeah. No, well, I'm in agreement with that. And just before we very sign off, because we don't have any other questions apart from the one that I put forward. So our 500 people must be looking the other way at the moment. We've all been talking about whether we're ready. Are the tax authorities ready? Because the discussion I had with our local tax academy here was that they were expecting us as professionals to train the Inland Revenue in all of this, which suggests to me that even if we file all these returns next year, they're not going to know what to do with them. I think that's another interesting situation. You know, what are they going to do with it? Murat, you get your thing filed on time, you avoid your $150,000, and then they just throw it in the bin because there's no tax to pay and they don't care.
Yeah, look, I think we've seen this in the past with Australia, where there's always a lag between when these filings or lodgements are done and when the tax authority starts to commence reviews of these filings. So it does take, like, I guess the tax authority in Australia, like the tax professionals in Australia, are getting their head around these rules and working through them. And I think, you know, there is no precedence around these, so there are going to be anomalies, issues that we're going to have to work through on a live basis. And you know, we would expect from an Australian perspective that, you know, the tax authorities will be gearing up appropriately, and we would expect reviews to be undertaken, which is consistent with recent sort of OECD-based multinational tax-based legislation that's come through. So it is a very strong focus area of the Australian Taxation Office, which is around ensuring multinationals their share of tax. So any sort of legislation that focuses on multinationals and the large multinationals, from an Australian perspective, we would expect to see compliance activity and reviews from the Australian Taxation Office.
So you're more upbeat about it. Sorry, there are questions. I pressed the wrong button. So let me just have a look at what we have. Oh yeah. So this is one around filing. Will there be filings required in countries in which the MNE operates that have adopted the rules, or one filing and then countries share the information? I think, Sasha, that was sort of the areas you were touching upon.
Yeah, so just to take an example, say, for example, you have a Dutch holding company with an Irish subsidiary underneath it, and you have a top-up tax to pay in Ireland. You will have to file your QDMTT return in Ireland. And then obviously, if that Dutch holding company is the nominated filer for the Globe return, it will file the wider return for the whole group. And that's an interesting concept as well, because where we have a lot of multinationals that may be, you know, we said China's not currently adopting the legislation, neither is the US, and they're ultimately parent entities at the top of the group. The question is, who do you elect to be your IIR filer? Because there's a huge amount of information currently under the Globe return that's going to be filed within that return and available to that tax authority. There's still discussion how that tax authority will share that information with other tax authorities. But again, it's an important point to consider from a filing perspective.
So everyone's going to try to avoid being nominated as the reporting entity. Is that right? They'll all be looking at their shoes and whistling.
Well, we're seeing, you know, practical discussions are, you know, where's your main finance function within the group? You know, who has the information? Who's going to be able to facilitate supporting this? So it's, you know, at some stages it has to be practical to be able to actually comply.
Yeah, sure. Okay, interesting. What are the ongoing tax services that your respective firms are offering or doing to companies in relation to BEPS Pillar 2? How can GT help for the covered companies under Pillar 2? Well, my next slide was going to be that, and I was proposing not to go through it in the interest of time, but it is left there, and you will get a copy of those slides after the event. But you know, in a nutshell, we can help you analyze your situation. Are you in or are you out? Do you qualify for any of the safe harbors? What filings do you need to do? How are we going to do the filings? What does a tax comp look like, et cetera, et cetera. But then you've got to realize that from then on, we're all stepping out into the great unknown. There may be fewer unknowns for us than there are for you. And of course, what will tend to happen is that as we are dealing with a number of clients, then a lot of these issues will be shaken out and will become familiar to us, obvious to us, and we would share that with you. That would be something that would happen much quicker in our environment than it would happening, you know, to individual clients on their own. So we would expect, even though it's all brand new and we're still feeling our way, that we would get up to speed on the practical sides pretty quickly. But have a look at the slides that are there at your leisure afterwards. Question. Oh, my friend Vimala. If parent company country has not adopted IIR or globe rules, can the DTT be avoided in the subsidiary country which has adopted globe rules and DTT? Kun Paul, how about you?
We're talking Singapore. No, it's if you're low taxed in Singapore from 1st of January 2025, then you will be paying domestic minimum tax. I don't know. Is that true across most jurisdictions you've seen in Europe? It's probably the only one I've analysed in great detail here.
Yeah, most of them are adopting the domestic minimum top-up tax, Paul. So yeah, to the extent they've adopted it, absolutely, it'll be caught in that particular jurisdiction.
Yep.
Okay. And then there's another one, a final one on India, second last. India has not yet made any law. How will it impact India headquartered companies having global presence? Where will the compliance required to be made? Was that the same sort of answer, Sasha, that you just went through? That the reporting entity it will depend on where the information is.
Do you want to take that one, Risha?
Yeah, maybe I can come in. So as far as the accounting goes, there is a draft which has been released by the Institute of Chartered Accountants, which is in line with IAS 12, which talks about the deferred tax accounting there. This has not been operationalized or notified yet. So as of now, from an accounting standpoint, there are no requirements of disclosure. So as far as India headquartered companies are concerned, if you look from an accounting perspective, firstly, we do not have any consolidation requirements per se. So individually, if you look at the accounts, the deferred taxes will not happen this time. We do not have the laws right now, so there will not be any impact on the current tax. But of course, as far as disclosures are concerned, if down the line there is a subsidiary which is operating in a low tax jurisdiction and there is some liability there, then even though there are no requirements as such under the domestic law, from a prudence perspective, if you are preparing the consolidated accounts, these disclosures may help. And then again, I'm saying from a prudence perspective. So that is the case right now. But as far as filings are concerned, till we have our India adopts the GLOBE rules, in India, there will not be any requirement for filing. You will have to assess basis the structure that you have, that where down the line there is another entity which needs to comply and whether that needs to comply or report for the entire group. So an assessment may be required to that extent till the time India adopts the GLOBE rules.
Okay. Okay, thank you. And then the last question left, Deepak again, I think, who asked the question earlier on India. I'm not sure if he finished his question. He says, "Hi, I'm having subsidiary in Australia, Singapore, and New Zealand." To which I'd say, well, get rid of them immediately because they will probably cause you trouble with BEPS. But more seriously, if you've got some specific questions around that, please do drop any of us that you think is appropriate an email, and be happy to have a chat with you. So I think that is the end, folks, as they say. We've had 3 minutes left on our sort of allocated time. So thank you, everyone, for coming. Thank you especially to our panel for a very, very interesting, I think, discussion and debate. And Deepak says he'll drop us a mail. So I look forward to seeing that. So thanks, everybody, and talk to you at the next event.